Okay, it's a rather worrying picture you're painting for people. How do you actually deploy our monies, our assets, and our clients' assets into this sort of environment?
Well, take it asset class by asset class. If you look at equities right now, they have already been beaten up pretty badly. They have already discounted a great deal of potential bad news. They've already discounted a great deal of lower, slower growth in the years to come. And if you look at valuations in equities and presume that we will muddle through, they actually look fairly attractive. So we're looking at keeping our equity exposure about a neutral position. And we'd like some exposure to larger cap companies that pay dividends, because the dividends that they're paying right now are actually higher than you get on long-term government bonds.
And also the compounding effect of dividends is actually probably a greater power for return in portfolios than just expecting the base share price themselves to be rising.
Yeah, we're probably not in an environment where you're going to see wildly attractive capital gains. So get the income reinvested, get the income reinvested. It's a theme that will replay through the asset classes. So that's the equity side.
But do you think actually in equities you will actually reduce the overall weighting in equities down to a lower level?
Well, what we've got ourselves now into is apparently a volatile trading range. So we jump up and down within 300 or 400 point ranges on the FTSE, and as we hit the upper end of that range, we are tending to lighten up a couple of percent as we do, and let it drift off, and it drives up again.
Selling into the rallies as it goes on there.
Yes,
okay.
Just to get us back down to a neutral position.
Now, the bond market, there's been a huge amount of concern over the bond market. Is it a big bond rally, as PIMCO have always been highlighting? So is this an area where we still need to keep our positions in bonds?
Well, government yields in the US and the UK are at 200-year lows. I'll repeat that, 200-year lows.
You remember that.
So it's a very, very significant moment in time that we're looking at. And the possibility exists that the quantitative easing programs have artificially depressed the yield on government bonds, intentionally so. Because that forms the cost of capital in the economy, and they would like that outcome. So when we look at yield spreads for governments versus corporates, and indeed corporates versus high yield, we find more value in the investment grade and the high yield corporate bonds than we do in the government bond markets just now.
So hanging on to the position in the government bonds for the time being?
It's a very small one. We probably couldn't go any lower in government bonds than we are at the moment. On a balanced portfolio, gilts are down around 5%.
Right.
But we do want to maintain exposure to the asset class of fixed interest, and we're going to be doing that more and more through the corporate, and then in the higher risk profiles, some of the high yield instruments.
Okay. Now, as a house, we've always focused on having much broader asset allocation than others. So what about some of those other asset classes? Let's look at, for instance, say property, for example.
Well, property worldwide has taken a pretty good hit. We're a little concerned that in the UK it hasn't come down to the extent that it has in other parts of the world. You can make the case that in the States and in Europe you've seen 30-40% drops in property, and in the UK we haven't seen maybe about half of that. Within the UK, we also have to be careful to distinguish between the London market and the market outside of London, because we have sort of two different distinct markets there. So we are a little wary that the UK property market, from a capital perspective, hasn't come off quite as far as some of the others. So we lightened up a little bit on the property that we have.
Okay, commodities, we've got the metals. They were the fashion of the past few years.
Yeah, they were. They've had the great run because of all the stimulus that we had in the world in 09 and 10. They have been coming off a little bit of late. But the problem that we have with metals is that they have no yield. And if our central muddle-through scenario is find yourself a yield with a bit of quality attached to it, get it, reinvest it, don't pay too much for it. The metals don't fit that description.
Right. So the metals, gold, all of that doesn't count. And the softs?
Right. The softs, if you're going to have exposure to the commodity area over the coming years, we think agriculture is probably the place to do it, on the basis that the world population is still growing at a very good clip.
The hedge funds, we've had a reasonable position of hedge funds, but we decided to make some changes there.
Yeah, we don't get everything right all the time, and hedge funds is one of the places I think we've got something marginally wrong. We got the exposure to the hedge funds because the correlation was supposed to be low when compared to equities and fixed interest. And because we stay near the exit, and that translates as everything that we have is liquid on a daily basis, the hedge funds that we bought were listed hedge funds. And because they were listed, they tended to behave more like equities than we wanted them to.
Some of those hedge funds had quite big discounts though, didn't they?
Huge discounts. About a year ago, they were about 40% discounts, and they've narrowed down to about 10 or 11% discount now on a lot of them. So we're taking that as an opportunity to lighten up on the listed hedge funds and replace them with these things called CTAs, or commodity trading advisors.
Now we added these earlier this year. Can you just briefly explain, just to remind people how they work and what they are?
Yeah, very quickly. They're a fund manager that trades futures, and that gives them the ability to go short. We can get in and we can get out on a day's notice, and they're not listed on the stock exchange.
So they're very different from how a hedge fund actually operates.
Yeah, we're the same concept, but a very different delivery, and we think now that we've looked at them for a couple of years, probably a much more effective delivery for what we are using it for, which is the low correlation.
Okay, quick word on currencies, absolutely crucial.
Yeah, it is. Since we have had the issues that we've had in the euro, you had the Swiss come out and say that they're going to defend their currency with unlimited amounts of money. The market's kind of waiting for the Japanese to do the same. So where do you go when the markets get a little bit twitchy? And the dollar has been the beneficiary of that in recent months, and is likely to continue that way, we think, for the next year or so.
Okay.
In the medium term, we see the currency value probably in the emerging market currencies. So what we're going to do now is we're going to increase. We have about 10% exposure to the dollar now. We're probably going to increase it to about 20% in the portfolios. Because the dollar tends to act as an inverse relationship to equities. So when equities go down, the dollar seems to get a bit stronger as a safe haven currency. And that's one of the ways that we can provide a buffer for volatility for our clients.
And for those emerging market currencies, how do we get exposure to that?
You can buy either emerging market debt, or you can buy the emerging market equities. A lot of the emerging market equity exposure that we have will be in large multinationals that won't necessarily be listed in the emerging markets. So to the extent that we do have emerging market exposure in those markets, we're leaving the currencies unhedged. And we have a little bit of emerging market debt, which we'll also leave unhedged. Okay. So dollar and emerging market currencies probably unhedged, and the rest of it pretty much hedged back to sterling.
And cash, do we steadily build that up over the next quarter?
That's actually one of the key decisions that came out of the meeting, was particularly with new cash flows, and as we continue to take money into 7 a.m., is to build up the cash position. We're already, as of this filming, up around 6 or 7% in a balanced portfolio. It wouldn't surprise me to go to 10 or a little bit higher than 10% in cash for the purpose of being opportunistic. Yep. There'll come a day with the volatility that we're seeing these days that you'll wake up one morning and say, that's gone too far, and I'd like to have the cash to immediately invest it. And that's all part of our near the exit strategy.
Well, I hope that gives you an idea of what happened in our asset allocation meeting. As far as we were concerned, making sure we have a clear view as to how to steer our way through this season of storms and make sure we look after your money most effectively, but also to give ourselves the flexibility to be able to move as and when necessary. Thanks for watching. Speak soon.